Hello everyone, today we talk about how does the stock market work. If the soul of investing in the stock market scares you, you are not alone. Individuals with very limited experience in stock investing are easily terrified by horror stories of the average investor losing 50% of their portfolio value. For example, in the two bear markets that have already occurred in this millennium or are ambiguous by hot tips that bear the promise of huge rewards but seldom pay off. It isn't surprising then that the pendulum of investment sentiment is said to swing between fear and greed. The reality is that investing in the stock market carries risk, but when approached in a disclaimed manner, it is one of the most efficient ways to build up one's net worth. While the value of one's home typically accounts for most of the net worth of the average individual, most of the affluent and very rich generally have the majority of their wealth invested in stocks. In order to understand the mechanics of stock market, let's begin by delving into the definition of stock and its different types. Key takeaways. Stocks represent ownership equity in the firm and give shareholders voting rights as well as a residual claim on corporate earnings in the form of capital gains and dividends. Next is individual and institutional investors come together on stock exchange to buy and sell shares in a public venue. Share purchase and sale by supply and demand as buyers and sellers play orders. Other follow and bid-ask spreads are often maintained by speculators or market makers to ensure an orderly and fair market. Listing on exchange may provide companies with liquidity and the ability to raise capital, but it can also mean higher cost and greater regulation. What is a stock? A stock is a financial instrument to represent ownership in a company or corporation and represents a opportunity claim on its essence and earnings. Stocks are also called shares or a company equity. Stocks ownership implies that the shareholder owns a slice of the company equal to the number of shares held as a proportion of the company total outstanding shares. For instance, an individual or entity that owns 100,000 shares of a company with 1 million outstanding shares would have a 10% ownership stakes in it. Most companies have outstanding shares that run into the billions or millions. Types of stock. While there are two main types of stock, common and preference, the term quite is synonymous with common shares as their combined market value and trading volumes are many magnitudes larger than that of preferred shares. The main distinction between the two is that common shares usually carry voting rights that enables the common share holder to have a say in corporate meetings like the annual general meeting or AGM, where matters such as election to the board of directors or appointment of auditors are voted upon, while preference shares generally don't have voting rights. Preferred shares are so named because preferred shareholders have priority over common shareholders to receive dividends as well as assets in the event of liquidation. Common stock can be further classified in terms of their voting rights, while the basic premise of common shares is that they should have equal voting rights. What would per share have? Some companies have dual or multiple classes of stock with different voting rights attached to each class. In such a dual class structure, class shares, for example, may have 10 votes per share, while the class B subordinate voting shares may only have 1 vote per share. Dual or multiple class share structures are designed to enable the founders of a company control its fortune, strategic directions, and ability to innovate. Why companies issue shares? Today's corporate giant likely had its start as a small private entity launched by a visionary founder a few decades ago. Think of Jack Ma incubating Alibaba from his apartment in Hangzhou, China in 1999, or Mark founding the earliest visions of Facebook, no matter. From his Harvard University dorm room in 2004, technology giants like this have become among the biggest companies in the world within a couple of decades. However, growing at such a frantic pace requires access to a massive amount of capital in order to make the transaction from an idea germinating in an Ontarian's brain to an operating company. They need to lease the office or factory, hire employees, buy equipment and raw materials, and put in place sales and distribution network, among other things. They require significant amounts of capital depending on the scales and scope of the business startup. Raising capital. A startup can raise such capital either by selling shares, equity financing, or borrowing money, debt financing. Debt financing can be a problem from a startup because it may have a few assets to pledge for loans, especially in sectors such as technology or biotechnology, where a firm has a few tangible assets plus interest on the loan would improve the financial burden in the early days. When the company may have no revenues or earnings, equity financing therefore in the preferred route from the most startups that need capital and entrepreneur may initially source funds from personal savings as well as friends and family to get the business of the ground. As the business expands and capital requires become more substantial, the entrepreneur may turn to angel investors and venture capital firms. That's all. Thank you for your attention. Goodbye.